So if you're looking at purchasing a property with a DSCR loan, what is the process you go through? What are the steps you have to do to make sure you're qualified and ready to go when the contract hits? With the rates coming down, we're seeing a lot more people out there looking to purchase properties with DSCR loans. A big question is, what is the process? What does it look like? How fast can I go through? And what are the numbers? What do I need to know, not only to bring in, but what are the closing costs? So there's three things that we always run through. Get approved yourself, quick and easy. Get the property approved, because the property, once again, is the income source that's going to qualify the DSCR loan. And number three, know your numbers. What is your down payment? What does the property qualify for a down payment? And what are your closing costs? Number one is get approved yourself. Comes down to a couple simple things. Since the income is based on the property, it's making sure you understand your credit score, where it is, and do you qualify with that credit score. Typically, what you want to see for good rates is something 740 and above. Anything 640 and below, there's still a couple options, maybe down to 600, but your loan to value is going to be different. They also want to know about your experience. Now, it's not required that you are a landlord currently or have been, but it's something that helps you as you go through for the loan to value and some of the rates. And lastly, where is that money? Where's the money for the down payment, the closing costs, the reserves? Where does that money sit? So simply, when you're looking at getting qualified yourself, you're just looking at what's your credit score, where's the money come from, where's it at, and your experience if you have it or don't. And if you don't, sometimes it just means putting a property manager in place. Number two, you gotta get the property approved, because the property and the cash flow is what makes the DSCR loan tick. You're gonna need to know what's the rents in that area, what's the taxes, the insurance, the HOA and flood, because when you're looking at a DSCR, that's what you need. You need to know the rents, and you need to know the expenses that they care about. They care about the mortgage payment, the taxes, the insurance, the HOA, and flood if those things are there. Now, if you need help with that, go to thecashflowcompany.com. We have a great tool there, the DSCR calculator. You can put those in, play with the numbers, play with the taxes, rents, all those things, and you can see where it qualifies. Now, we're talking about DSCR loans and qualifications based on the property, but what if it's not rented? And most of them won't be rented. No worry, you don't need to have a lease in place to qualify for a DSCR loan. What the lenders look at is the appraisal. The appraiser goes out and does what he calls a rent schedule. He verifies, checks rents in the neighborhoods. What are they going for a like property? He puts this all together. He gives an estimate to the underwriter, and that's what they go out. So you don't need a lease in place, but you're going to have to know these numbers just to make sure it qualifies before you get into a loan. Number three is knowing your numbers. First off, what is your loan to value? How much do you have to put down on the property? And does the property qualify for that loan to value? Because remember, we're talking about a DSCR loan. The income from that property is the only thing they look at for that DSCR loan. So you cannot add income from other properties or your personal income to make it qualify if it's a little bit short. You have to make sure it qualifies. And sometimes what that means, instead of putting 20% down, you have to put 75% down, just to make sure the property qualifies for break even or better. Now, here's an example of when it doesn't qualify at 80 and qualifies at 75, and then why you should know your numbers. Let's just say there's rents in the neighborhood. They're going for $2,300. You went out to Zillow, you went to rents.com, you find out that rents in the neighborhood are $2,300. But at 80%, your mortgage payment, your taxes, and your insurance, and anything else comes out to $2,500. Rents are $2,300, your expenses are $2,500. It's in a negative cash flow, so it's not going to qualify at 80%. Yes, there are DSCR loans out there where it does not have to cash flow, but you're going to pay a lot higher rate, and it's going to even be less cash flow coming in. Now, let's say that same property comes in at $2,100. Now it cash flows. Now you qualify. So at 75% it qualified, 80% it didn't. Some of the reasons they may not have is because once you go from 75 to 80, anytime you keep going up in loan to value, your rates are going to increase. So from 75 to 80, your rate increased and your loan amount increased. With both of those increasing, your payments are going to go up. And that's why you're going to need to know all your numbers before you go into this, as far as where it qualifies for the down payment, because that's part of the money you're going to bring in. Number two, you're going to bring in closing costs. Depending on what you negotiated with your contract and with your seller, you're going to have to bring in closing costs. Typically anywhere between, let's say, on average, $1,500 to $2,500 for a $250,000 purchase. But check in your area, because there might be mortgage taxes, there may be something else that go with the closing in your area. Now, as far as the loan and costs that go with the loan, typically what you're going to find is 1% of the loan amount is charged, along with somewhere between $1,500 and $1,800 for underwriting, docs, legal, all of those items put together. Next comes the appraisal. It's between $900 and $950, and that goes directly to the appraiser to make sure they get their work done and get paid for it. And lastly, it's building those escrows. It's paying the insurance up front. So whatever your insurance policy is, you're going to pay 12 months of that. You're going to pay a full year. Plus, you're going to put somewhere between 2 and 6 months into an escrow account. So when those taxes and insurance are due next year, they're paid by the mortgage company. So if you look at this for total out-of-pocket, you got your down payment, you got your title or closing costs, you have your lender costs, and you have your escrow. You add all those numbers up, and that's what you're looking at bringing in at closing. Plus, you're going to need some reserves, somewhere between 2 and 6 months of mortgage payments. You're going to have in reserves because the company who's lending you the money for the DSCR wants to make sure you have some reserves just in case it's vacant for that first month or two, or just like any rental, it could be vacant for any period of time. Drop a comment if you have any other questions on purchases, how it works for DSCR. Remember, there's 3 things. It's you getting qualified, the property getting qualified, and knowing your numbers. Putting these 3 things together will make that purchase process easy on the DSCR. Help out some other investors by sharing this video, liking it, leaving us a comment, and we'll catch you on the next vid.